the International Conference on Accounting and Finance.
Department, that is in the Faculty of Science. So here this analysis of this study will be more or less scientific methodology I will be using, because here I am more or less talking about the mathematical or the technical feasibility in introducing options to the Sri Lankan context. So this is the presentation outline. First I will be talking about the significance of the study, why I am thinking to, or why I am seeking the feasibility to introduce options to the Sri Lankan context, and then there will be a brief introduction to the options, because since we are in the inception stage of the introducing options or derivatives, so it is I thought it will be important to discuss some give some note about the options. Then I will be talking about option pricing method, that will be the Black-Scholes formula, and its determinants I will be talking. Then here we don't, at the current moment we don't have any market prices. Here what will happen if we introduce options, or what will happen if we price the options, then what will happen in the market. So then the conclusions and suggestions. So here, introduction of financial derivatives, there are several arguments. Some scholars are telling it's good to introduce options or equity options or stock options to the market, because it will strengthen the financial stability, or it will strengthen the liquidity of the market, and market will be more functioning. And some are supporting this argument. They are saying with the introduction of the derivatives, market will be more efficient and the liquidity will be going up. Because of the information asymmetry will be go down, and so something like that. But there are some schools of thought, some are arguing that with the introduction of derivatives, people will leverage their debt. Because of that reason, the trading of stocks will be go down, and it will be badly affected for the stock market. So there are conflicting arguments in introducing options. Therefore, it's good to see what will happen in the history, what are the lessons that we can take from the history, and so here also we were having that hedging contract that was that did bad for us as a whole economy, and so in this study I am trying to see what are the legal feasibility and technical feasibility of what will be happening when we are doing pricing, and what are the other operational feasibilities in introducing options. The first thing is just a note about the options. Normally there are two types of options, call options and put options. There are key terms, or the important aspects that we need to know when we are talking about options. Option is a kind of a derivative. Derivative means it's the price of the derivative is derived from some other underlying asset. The underlying asset will be it will be a commodity, it will be a stock or index or whatever. Then there is an expiration date, exercise price, and the premium. Premium is the stock price. Normally, it is the price that the buyer of the option has to pay to the seller of the option. So call option gives the right to the option holder to buy if he want. If he exercises his right, then the seller or the written party is obligated to sell the asset. So there are some properties. Normally people, so when it is a call option, if it is a call option, it's like warrants or convertible bonds. If the stock price is going beyond the strike price or the agreed price on the option contract, then people will definitely exercise their right. In that case, the payoff will be positive for the holder, and the similar amount will be negative for the seller. That means it is a zero-sum game. For a put option, the option holder is having right to sell the to right to sell the asset if he want. That means if the market price goes down the strike price, then he will be selling asset. In that case, the seller or the written party is obligated to buy the asset. So in that case, if markets go down, that means market is getting short, then the option holder will be having advantage. So in that case, he will be having positive payoff. So this is the basic, the formula, the pricing method that I use, Black-Scholes formula, because here there are two types of option contracts. That means European style and the American option style. In addition to that, there is another type of style that is called Bermudian style. So normally in the history or in other countries, they started, or they are currently using the stock. When they are using the stock options, they are using Black-Scholes they are using European options. Therefore, the Black-Scholes formula is the best method to calculate the option prices. So this is the option, the pricing model. We need to, this C means the call option price. We need to think about the exercise price, and the underlying price of the asset, strike price, and the interest rate of the risk-free rate of the economy, and the volatility of the market, volatility of the stock. So here, by using the Black-Scholes has suggested this model to calculate the put prices or we can use the put call parity in order to calculate the put price after we calculated the call price. So put call parity will be discussed later. Here there are certain assumptions. Here when we are using this Black-Scholes formula, we assume that the volatility is a constant. That means the return should be stationary, and the risk-free rate is also constant. So it is, and it assumes that the short selling is permitted, but here currently we don't permit short selling, but we are using margin trading. So here the recent crisis in the stock market will mainly cause because of those margin trading, and it will be a lesson from the history. And there is another assumption, that is no transaction cost. Here let's see, these are with my calculations I developed some. So these are the movements of the determinants with the call price. So here I just pick a snapshot, that is here the strike price is 30 and 91, there is 3-month call option with interest rate 8.4%, and the selling price is 31.5. So with the call price standard deviation, so here the call price with respect to the volatility. So here we can see when the volatility is going up, the call price or the risk is going up, therefore the call price going up. Then with the call price is also positively correlated to the current stock price of the market, because when it comes to the call options, if the current market is very high, then the call price also having more risk, therefore the call price going up. Then the exercise price is negatively correlated to the call price. So those are some fundamental facts, and risk-free rate is also having a positive correlation. So normally we know that in current also here we are having 6.7 interest rate in terms. But when I calculated these things here, it was in 2009 region, that is after the war, because at that time our stock market is highly active, and it was before 2009 with the war and all those things. It was kind of an inactive era of the stock market, and so the liquidity was a problem, and because of that reason I picked after 2009. But at that time our interest rate also very high, it was nearly 16% or something like that. So this is the behavior with the risk-free rate. So with the maturity periods, it was again positively correlated. So put call parity can be used to compute the put prices and to see whether there are any arbitrage opportunities. So here technological feasibility, first I use some already traded prices to make sure that my pricing is correct, and there were some legal amendment in the SEC, Securities and Exchange Commission. They have amended the Securities and Exchange Commission Act, that is 2009-47, and under that act they identified or they defined the options or the derivatives as a security in Sri Lanka. After that, we had to have clearing corporation. Currently we are having this the clearing house. It's not enough. We have to have some AAA credit rating or the very risk-free operation, the option clearing corporation. So these are some price calculations to make sure that my calculations are correct. In that case, I understand some key points. There we have to use the dividend in percentage terms, annual percentage terms, and we had to use the risk-free interest rate in continuous compounding manner. So with those things, I calculated some stock prices here. So we don't actually I don't have enough time to here. We can see the strike price, the current trading price is 31.5. Here the volatility is somewhat bigger, but the interest rate also bigger, it is 16.8. So with that, so around the strike price, there are concept called in options moneyness, that is in the money, out of the money, and at the money. So if the option is trading near to the stock price, the strike price is near to the the stock price, spot price, then it is called as at the money. So for a call price, strike price when goes down, it is becoming when the strike. So when here you can see the call prices are getting bigger when the strike price is getting lower. So that means the risk is going up. So here we can see. So here I calculated some profit graphs for the calls and puts, and we can see what is the behavior of option prices with respect to the stock prices. Here we can see more or less they are same. Here we can see the gap is somewhat a constant. So with this things here, I use the interest rate where it is more or less half as the earlier. Earlier it was 16%, now it is 7%. So these are some option prices for highly liquidate stocks at that time. But with those stock prices, but with those movements, we can see the risk is still there, because we can see the stock price the option price movements are more or less same with the stock price. That means if there are any inefficiencies in the market related to the stock prices, then those inefficiencies are mingled with those option prices in the same degree. So with those and with those things, and when it compared to the other foreign markets, our volatility is somewhat high still. So that is the main reason, and the risk-free rate, the highest risk-free rate, also creating some problems when trading. Though calculation can be done, but the problem is the trading. If those prices are somewhat higher, then no investor will be investing their money. So I check for simple arbitrage opportunities. Because of the lack of market data or the non-availability of market data, I can't use any market values to talk about those volatility smiles and volatility clustering and all those things. So therefore, this is just a fundamental study. This will be important for our regulatory authorities when they are, because now there is a debate whether to introduce options or not. Some are telling it is good, some are telling it is not good. So here, that's why it is timely done this study. According to my observation, it's not good, because here we can see there are few factors in risk factors that we cannot avoid. Among them, so these are some fundamental risk factors. Among them, we had to have there are several types of risk: primary risk, secondary and idiosyncratic risk. Apart from that, this delta risk, that means the hedging ratio. So what is the sensitivity of option prices with respect to the stock prices? So that aspect we have to think about when we are before to introduce options, because before to introduce options we had to practice short selling before to the introducing options, because short selling can itself make some problems before trading options. And if short selling we can done properly, then we can go for the futures trading, then index, because with the individual stocks we cannot do better. Therefore it's better to make a portfolio to reduce the volatility. In that case we can use the index to reduce the volatility, so that it will be a better path if we are deemed to introduce options. So that's it. So with my conclusion, so here currently we are not in a position to introduce options. Education is a prerequisite, because most of the investors don't have any proper idea what are the capabilities or what is the gravity of introducing options to the financial market. Therefore it is a must, and the Securities and Exchange Commission is having a liability to introduce or educate investors and the other communities about the options and its gravity in the financial market. Short selling should be proceed with prior to the options, and if we didn't follow those things, we'll be end up digging mud rather than digging gold. So it will be a catastrophic inception if we do not follow the proper steps. So that's it, and thank you. If you have any question, you can ask.